Welcome to The Explainer. Today, we're diving into the timeless wisdom of Benjamin Graham. We're going to pull out two powerful ideas from his classic book that might just change the way you think about every single stock you own.
So let's start with a really simple question, but one that has some surprisingly deep implications. You might own stock in a company, maybe a lot of it, but do you really think of yourself as an owner?
And here it is, straight from the man himself. This is the bedrock of intelligent investing. It seems so obvious, right? Of course you're an owner. But Graham saw that this is an idea we've almost totally forgotten. And that's where the trouble starts.
You see, Graham was just constantly baffled by the fact that shareholders, the actual kings and queens of their companies, so often act like they're just watching a show. He even called them sheep-like, just kind of passively going along for the ride.
He argued that this passivity is a huge problem. It means management gets to operate with basically no real supervision from the people who actually own the business. I mean, think about it. If the owners are asleep at the wheel, who's watching the store?
Let's take a famous example, Enron. The warning signs were right there, hiding in plain sight in the company's official documents. Any owner who was actually paying attention would have seen that the chief financial officer was running these side businesses that were buying assets from Enron, and that he was personally profiting from them. And to top it off, Enron was loaning these side businesses the money to do it. You don't have to be a financial genius to ask, wait a second, isn't this a massive conflict of interest?
And this shareholder passivity, it has a very direct impact on your wallet. It's completely changed the power dynamic in one of the biggest fights in the business world, the fight over what a company should do with its profits. Just look at the difference. Back in Graham's day, it was simple. The profits belonged to the shareholders, period. They demanded their cut. But today, we've moved into what you could call a daddy knows best era, where management says, hey, don't worry about it. We know how to use your money better than you do.
And the pitch they made was really tempting. Don't take this cash as a dividend. Let us keep it and reinvest it for you. We'll make the stock price go to the moon. But did they actually deliver on that promise? Well, a lot of the time, the answer was a huge resounding no. The cash that wasn't paid out to the owners, it got torched in disastrous mergers and crazy ego-driven projects, wiping out unbelievable amounts of shareholder money along the way. Okay, so if dividends are less common, what about the big modern alternative, the stock buyback? Now, on the surface, this sounds pretty good for shareholders, but sometimes it's hiding something a little more sinister.
So the theory is really simple, right? The company uses its cash to buy its own stock. That reduces the number of shares out there, which makes your remaining shares more valuable. It sounds like a total win-win, but here's how this can get twisted to help insiders, right at the owner's expense.
So here's how the game is played. First, the company gives its executives millions of stock options. Then, when the execs cash in those options, it creates a flood of new shares on the market. That waters down the value of your shares. It's called dilution. So to clean up that mess, what does the company do? It uses your cash, the company's profits, to buy back shares, often at really high prices.
And this isn't just a theory. Look at these numbers from Oracle. The company issued stock to its own insiders for an average price of about $3.50. Then, to offset all those new shares, it used company money to buy back stock on the open market for over $18 a share. Think about that. Sell low to your friends, buy high from the public. It's an amazing deal for the executives, but a pretty raw deal for the actual owners. So, if you're an owner and you can't always trust that management is looking out for you, how in the world do you protect yourself? Well, this brings us to Graham's second core idea. And this is his ultimate secret weapon. Graham was convinced that the entire secret to being a sound investor could be boiled down to just these three words: margin of safety. So what does that actually mean? Well, it's not about being a genius who can predict the future. It's about building a cushion. It's about buying something for a price that's so reasonable, it gives you room to be wrong. It protects you when things don't go according to plan. It basically makes trying to predict the future unnecessary. And for Graham, this idea is the bright, shining line that separates true investing from just gambling or speculating. An investment has a margin of safety that you can prove with real numbers. Speculation, that's just a bet, a hope that you're right, with absolutely no protection if you turn out to be wrong. And the price you pay for ignoring this principle, it can be absolutely devastating. Let's say you bought a hot tech stock like JDS Uniphase back at the peak of the dot-com bubble. You paid a price with zero margin of safety. Even if the company managed to earn a really solid 10% return for you every single year after that, it would still take you more than 43 years just to get your original money back. 43 years. So when you put it all together, acting like an owner, demanding a margin of safety, all of Graham's wisdom really points to one final, powerful truth. The biggest danger to your money isn't a bad company or a volatile market. It's actually a lot closer to home. Just let that sink in for a second. Your own behavior, your own mindset, your own discipline. At the end of the day, that's what's going to determine whether you succeed or fail. The biggest risk you'll ever face as an investor is the person staring back at you in the mirror. So how do you manage that risk? Well, it comes down to asking yourself two brutally honest questions before you ever put a dollar to work. First, do I really, truly understand this as well as I think I do? And second, how am I going to feel and what am I going to do if it turns out my analysis is completely, totally wrong? And that leads us to the final critical lesson. You can never truly know the future. And because of that, the intelligent investor stops trying to guess the odds. Instead, they focus all their energy on making sure the consequences of being wrong are never fatal. That's the margin of safety in a nutshell. It's not about being right all the time. It's about building a financial life where you can afford to be wrong,